Hello, everyone, and Happy New Year. And today, with the stock market doing kind of a yo yo pattern, it has mostly been going up over the last week or two. I figure it would be a good idea to start talking about dividend stocks again. So, I'm going to be going over another dividend stock. It used to be a monthly dividend stock, but it was downgraded in 2021 to a quarterly stock. So, it adds up to about the same, roughly, when you do the counting of the monthly compared to the quarterly. So it doesn't really change money wise, just the payout time has changed. So I'm going to be going over its financials, its stock performance, and other key points about it, and give you my opinion on if it is worth buying the stock or not. And I will be going over that information right. So in this video, I'm going to be going over American Finance Trust, ticker symbol AFIN. Again, that's A as in Apple, F as in Frank, I as in India, N as in November. It is up 22.88% over the last year. It is currently, as of January 4th, 2022, trading for $9.34 after hours. It has a dividend rate of 85 cents per year, which turns into a yield of 9.27%. So that is just the basic stuff for right now, and it looks good at a pretty high yield of 9.27%, but there's more to this story, so don't forget to hang out for the rest of the video. This company is a real estate investment trust, better known as a REIT. It is a publicly traded real estate investment trust listed on the NASDAQ, focused on acquiring and managing a diversified portfolio of primarily service-oriented and traditional retail and distribution-related commercial real estate properties in the United States. It was founded in 2013 with its headquarters on Fifth Avenue in New York in the United States. So, as for their portfolio properties, they have it split up into both single and multi-tenant properties and the type of service that they have. So, for service and traditional retail, as well as distribution and office space, for a single tenant property, 10% of their properties are to gas or convenience stores, 7% to healthcare, 6% to retail banking, 6% to fast food restaurants, basically, 4% to groceries, 4% to automotive services, 3% to just a casual store, then 2% to a full service restaurant, 2% to pharmacy, and then they have for traditional retail, a discount retail like your Dollar Generals at 3%, then 2% to auto retail, like your AutoZones, 2% to home improvement, for instance, Home Depot, then 1% to furniture, 1% to specialty retail, 11% to distribution, and then 7% to office. Then the rest of theirs is to multi-tenant properties, so 15% to experiential or e-commerce defensive, and then another 15% for other traditional retail, sporting goods, wireless electronics, pet supplies, things along that nature. The top 10 tenants that they have is at 6%, a Sanofi, which is a pharmaceutical company, then 5% at Truist, 5% at Fresenius Medical Care, then 5% at Mountain Express Oil Company, and it goes on at 3% at Stop and Shop, 3% Bob Evans, 3% is Dollar General, 2% is Home Depot, and another 2% is at Best Stop. And that is just the top 10 tenants. There are other ones that you can look at. If you look over here, if you want to come to their site at AmericanFinanceTrust.com, you can go to their portfolio. You can look at their feature properties, their multi-tenant properties, their diversification, and look at all their properties that they have. They have properties in 47 states, so they are fairly well diversified. And this way you can take a look yourself. So this REIT does seem to be a fairly good company so far, at least at this point in my research. They do have some well-known tenants like Home Depot. They also have others like Bob Evans that I looked at earlier. And they do have what looks to be a well-diversified portfolio of properties across 47 states. Again, this is not all there is to the story. It's nice to know this information, but there is more that I'll be going over in both looking at their dividends and how they changed in 2021 and how they are still similar to when they were monthly, and also going over their actual financials, so their profit and what their revenue was. And I will at that point give you my personal opinion. It's not recommendation or advice, but my personal opinion on if this stock is worth investing in or not. As I went over at the beginning of the video, you can see that according to their dividend summary here on Seeking Alpha, they have a 9.27% dividend yield with an annual payout of 85 cents per share per year. They have a payout ratio of 93.41%. I know that may seem high, but if you're not familiar with it, REITs or real estate investment trusts are required by law to pay out at least 90% of their profits to their shareholders. They have not had any growth over the last 5 years, and they have not grown their dividend at all, at least ever since the pandemic hit. So they, again, pay their dividend out quarterly, and that is at 21 cents per share per quarter. Their ex-dividend date, for instance, this month is on the 12th, so you need to own the shares of the stock before that date. You cannot just buy it on that date. You actually have to have it before that date. That way it can be properly recorded. I know others say you can go ahead and get it on the ex-dividend date. I have tried that myself personally in the past, and it does not work. So at least make sure you buy it a day before the ex-dividend date if you are interested in owning the stock for its dividends. Just looking at some basic stats and performance on Robinhood, which I like looking at just for its ease of use. You can see up until about November, right around the time of Thanksgiving, it has its ups and downs, but it was mostly going flat for the most part. And then around Thanksgiving, it took a sudden nosedive, losing about 60 cents, which equates to about 10%. And then it climbed back up within a week, went back down, and now it's on a steadily climb right now. So that's good. This company has monthly options, so it's definitely not one of my favorite ones for doing any kind of options plays. As you can see, you're going to get just about nothing for selling a put, which would get you 100 shares if you were to get assigned. Even going out next month, going out 2 months, and then going all the way even to June, you would only get a 20-cent per share premium, and that's really not worth the tying up of $750 for 6 months. So selling a put to get your 100 shares isn't really worth it. Now, if you already have 100 shares, is selling a call any better? And as you can see, it's not really any better at all. It still doesn't really pay much of anything, but at least for selling a call, you do get the 13 cents per share or $13 total at the $10 range. But you would have to have those stocks tied up as collateral until March 18th. And at least until then, most likely you would still get the dividends as long as the stock doesn't go above that strike price right before an ex-dividend date. Because if it did, then it could easily be called away and you would not get those dividends. Now in June, it's slightly better at $35, but again, you would have to keep those shares tied up for 6 months. So as you can see, clearly doing options for this dividend stock is not really a good idea. You can use it to make a little bit of money if you already have 100 shares, but it's not really recommended. Now going over an easier way to understand their financials, I like using TradingView. They have a financial chart here that you can look at. It's much easier to understand. I have it set here for years. As you can see, in 2016, right here, and 2017, they both had positive revenue and positive net income with a nice healthy profit margin. So at this point, I would have considered this a value stock. But then in 2018, something happened and their revenue dropped and their net income dropped a lot to where they were no longer even profitable. And even though the revenue has stayed right about the same, they still have not really recovered. So I would say this company is going to be in the rebuilding phase still. So I'm unable to find any reason in 2018 as to why their profits dropped so much. Only thing I was able to find out is 2018 is when this company actually entered the stock market with the NASDAQ. And it's possible they just did not have a very good earnings, and so that dropped their profits considerably, considering they may not have been able to get the investors like they were hoping to. So my personal preference on this stock, what I plan on doing is I plan on keeping this stock on my watch list because looks like a interesting stock, especially for a high yield dividend stock. But as of right now, my personal opinion is it is not safe to invest in this stock currently. Now, that's not to say you can't. If you do your own research, feel free. This is just my personal opinion and what I am going to do myself. And I am personally going to hold off to see how they perform over the next 3 to 6 months. Over the next couple quarters, I want to see how they perform to see if you like this video. Don't forget to hit the like and subscribe down below. It does greatly help out my channel. And I also have a link to my Discord in the description below. You can join that for free, where I give my stock picks every day. Hope you have a great day in the stock market. Stay safe and stay well.